After studying this module, you shall be able to understand the characteristics and objectives of the institutions facilitating industrial finances. To understand the different classification providing industrial finance and term lending, to learn about various term lending institutions like IFCI, IIBI, Axiom and TFCI. After independence, it was realized that the existing financial arrangement was incapable of providing the needs of long-term industrial finance. Therefore, term lending institutions or development finance institutions, commonly known as DFIs, were set up in India at various points of time starting from the late 1940s to cater to long-term financing requirements of industry. Term loans are loans which are sanctioned for a period exceeding 1 year with specific schedule of repayment. They are mostly extended to industrial projects. The first step towards building up a structure of development finance institutions was taken up with the establishment in 1948 of the Industrial Finance Corporation of India IFCI with a view to providing medium and long term credit to units in the corporate sector and industrial cooperatives. Let us now study the various characteristics of term lending institutions. They do not mobilize savings from the ultimate surplus spending units. The major source of their funds were funds from the RBI and the government guaranteed bonds. These funds were available at concessional rates on long term basis with maturity period ranging from 10 to 15 years. However, with the financial sector reforms in the 1990s, concessional lending by the RBI and the government was phased out, leaving the financial institutions to rely for financing their needs on the equity capital and the debt markets. Recently, some DFIs have started extending short-term working capital finance, although term lending continues to be their primary activity. Of late, a number of financial institutions have diversified into several new activities such as investment banking, infrastructure financing, and providing guarantees for domestic and offshore lending for infrastructure projects. They have mostly been set up as statutorily by the government, but some private sector participation in the ownership and functioning of some of them may also exist. They are usually special or specialized, but some of them may have a much general functional coverage. The distinctive characteristics of development banks lingers around promotion or motivate, encourage and stimulate development in one sector or another. In a way, they play a catalyst role in the development. Some other characteristics features of a development banks are: it is a multi-purpose specialized financial institutions. It strives to promote economic development. It provides refinance to other financial institutions. It provides a package from services from identification to management. It arranges for a package of incentives to entrepreneurs. It provides institutional innovations entrusted with development. It is a visionary institution. It is a link that spurs all-round development. Here one point needs to be mentioned, that as far as the innovation is concerned, the capital market regulator SEBI provides very little scope for innovation of various financial products by the development financial institutions or the financial institutions per se. Whatever product they develop, it has to take the approval, and in majority of the cases the product approval is given on a case by case basis. We shall now discuss the classification of term lending institutions. There is a well integrated network of financial institutions in the country, comprising 44 institutions at the national level and 82 at the state level. Broadly, they are classified as follows: All India financial institutions, which include All India development banks, specialized institutions, investment institutions, refinance institutions, state level institutions, which include state financial corporations, state industrial development corporations. All India development banks. These banks are the main source of medium and long term project financing. Development banks are different from commercial banks in several aspects. Firstly, development banks do not accept deposits from the public as commercial banks do. Secondly, they specialize in providing medium term and long term finance, while commercial banks generally provide short term credit for working capital purpose. Thirdly, development banks perform promotional role for industrial development of the country, whereas commercial bank provides utility and other services to their customers, which are corporates. Among the AIDBs, IDBI, IFCI, ICICI, IIBI and DFC provides financial assistance to medium and large enterprises. SIDBI, SIDBI and SFCs cater to the needs of small and tiny enterprises. Specialized financial institutions, Axiom, IDFC, TFCI of the SFIs, RCTC and TDICI provide risk capital, venture capital and technology development finance, and TFCI extends finance to hotel and tourism related projects. LIC take care of the businesses of life insurance, GIC offers general insurance facilities, UTI mobilizes saving and channelizes them into corporate investments. Investment institutions. The investment institutions are major players in the secondary market. They also extend assistance to corporate sector by way of term loans, underwritings, direct subscription to equity and debentures. The SFCs provide finance mainly to small and medium enterprises, whereas SIDCs cater to the needs of medium and large industries in their respective states. Apart from providing financial assistance, SFCs and SIDCs also play a promotional and developmental role. They have played significant roles in the mobilization of household sector savings and their development in credit and the capital market. Major institutions in these categories are UTI, LIC and GIC. Refinance institutions. Two institutions in this category are noteworthy. Both of them are also vested with certain supervisory functions, NABARD, and the second one is National Housing Bank, commonly known as NHB. State level institutions. Operations of the state level institutions are generally confined to their respective states. The two most important institutions in these categories are State Financial Corporations, SFCs, and State Industrial Development Corporation, SIDCs. We shall now discuss the various principal functions. The various principal functions common to all development banks are promoting investment to public and private capital for development, mobilizing resources and using them judicially and productively, providing technical assistance to help prepare, finance and carry out development projects and programs, cooperating with government, Reserve Bank of India, with development banks and other organizations that are concerned with the investment of development funds, promoting institutional infrastructure to accelerate the process of economic development, train entrepreneurs and professional managers. Let us throw some light on the detailed explanation of TLIs. Export-Import Bank of India. The Exim Bank was set up in January 1982 as a statutory corporation wholly owned by the central government. It paid up capital in 1988-89 was rupees 220.5 crores. It grants direct loan in India and outside for the purpose of export and import, refinance loans of banks and other notified financial institutions for the purpose of international trade, rediscount export bills of banks, provides overseas investment finance for Indian companies towards their equity participation in joint ventures abroad and guarantees along with banks obligations on behalf of project exporters. One of the facilities which the Exim Bank provide is the forfeiting facilities. It is also a coordinating agency in the field of international finance. It undertakes development of merchant banking activities in relation to export oriented industries. It thus provides fund based as well as non-fund based assistance in the foreign trade sector. Specifically, its products and services includes post shipment term finance, pre-shipment credit, term loans for export oriented units, overseas investment finance, finance for export marketing, overseas buyers credit lines of credit to foreign government, relending facility to banks abroad, rediscounting of export bills, refinance of export credit, bulk import finance and research, analysis, advisory and information services. Its sources of funds come from share capital, reserves, repayment of loans, loans from the RBI and government, bond issues in the domestic and foreign capital market, loans from international financial institutions and so on. Industrial Finance Corporation of India, IFCI. This is the first term financing institution and was set up in July 1948 by the Government of India under the IFCI Act 1948 with the objective of providing medium and long term loan to large industrial concerns in private sector. It provides direct rupee and foreign currency loans for setting up new industrial projects and for expansion, diversification, renovation and modernization of existing units. Its resources are in the form of loans from the RBI, share capital, retained earning, repayment of loans, issue of bonds, loans from the government, lines of credit from foreign lending agencies and commercial borrowing in international capital markets. Tourism Finance Corporation of India, TFCI. TFCI was set up on 1st Feb 1989 as a public limited company under the Companies Act by IFCI, other All India financial institutions and banks. Its paid up capital is rupees 50 crores. It is a specialized All India development financing institutions which provides assistance in the form of rupee loans, foreign currency loans, underwriting of and subscription of industrial securities, deferred payment, foreign loan guarantees, suppliers credit and equipment leasing. This form of assistance is utilized for the development of tourism and tourism related activities, facilities and services. These includes travel agents, highway facilities, ropeways, car rental services, ferries for inland water transport, air facilities, hotels, restaurants, holiday resort, amusement park, transports and so on. It would also provide advisory and merchant banking services in this field. It is to coordinate activities, formulate guidelines and policies relating to financing tourism projects. The projects with capital cost of rupees 1 crore or above are generally eligible for assistance from TFCI, although smaller projects could also be considered. It would provide assistance jointly with state financial institutions for projects with capital cost of rupees 1 crore to rupees 3 crore and on a consortium basis with all India financial institutions for bigger projects. Again, the volume of operations of TFCI has remained small. Its cumulative sanction and disbursement till March 1996 were rupees 1026 crores and rupees 543 crores respectively. Industrial Investment Bank of India IIBI. The Industrial Investment Bank of India is a 100% Government of India owned financial investment institutions. The Industrial Reconstruction Corporation of India Limited was established in 1971 by resolution of Parliament of India under section 617 of the Companies Act, with a view to converting the institutions into a full-fledged development financial institutions. It was incorporated as IIBI in 1997. In 2006-2007, it was decided to close the bank. Now it is operating from its office in Kolkata. It provides term loan assistance for project finance, short duration, non-project, asset-backed financing, working capital, other short-term loans to companies, equity subscription and asset credit. We can now conclude in the following manner. DFIs in India have had a long and successful history and were visualized in a role complementary to commercial banks, primarily to fill the gaps in lending activities of long gestation that were not catered by the commercial banks. Development financial institutions have a greater role to play when it comes to the India's growth story. Development financial institutions are providing infrastructure financing to various infrastructure sector companies. Say for example, road, railways, power, which is more important, ports, to name a few, which has a leading role to play in the India's growth story. Development financial institutions pay the long-term loans to these infrastructure companies with the intention that the amount which they are getting back is for a longer period of time. Hence, the amount of loan which they give stands under long gestation period. Infrastructure, when DFI is giving infrastructure finance to companies, they don't mind if the debt equity ratio of these infrastructure companies is say 7:1 or 8:1. The high debt is the need of the hour to support the infrastructure sector because private equity participation in infrastructure sector is less. The private equity participation in infrastructure is less because they don't want to expose the risk involved into infrastructure sector. And to take care of this risk profile, the development financial institutions comes into the picture when they give long gestation loan to these infrastructure companies. We shall now recapture what we have learned so far. Term lending institutions or development finance institutions were set up in India at various points of time, starting from the late 1940s to cater to long-term financing requirements of industry. They do not mobilize savings from the ultimate surplus spending units. The major source of their funds were funds from RBI and government guaranteed bonds. These funds were available at concessional rates on long-term basis with maturity period ranging from 10 to 15 years. However, with the financial sector reforms in 1990s, concessional lending by the RBI and the government was phased out, leaving the financial institutions to rely for financing their needs on equity capital and the debt market. Recently, some DFIs have started extended short-term working capital finance, although term lending continues to be their primary activity. We have also discussed the principles, functions common to all development banks, which are promoting investment of public and private capital for development, mobilizing resources and using them judiciously and productively, providing technical assistance to help prepare, finance and carry out development projects and programs, cooperating with government, Reserve Bank of India, with development banks and other organizations that are concerned with the investment of development funds, promoting institutional infrastructure to accelerate the process of economic development, trained entrepreneur and professional manager. Of late, a number of financial institutions have diversified into several new activities such as investment banking, infrastructure financing and providing guarantees for domestic and offshore lending for infrastructure projects. Term loans are loans which are sanctioned for a period exceeding over 1 year with specific schedule of repayment. They are mostly extended to industrial projects. The major source of their funds were funds from the RBI and government guaranteed bonds. There is a well integrated network of financial institutions in the country comprising 44 institutions at the national level and 82 at the state level. Although development financial institutions are catering to the needs of the corporate sector, particularly the infrastructure sector, but at the same time corporates are advised to raise their resources to fulfill their diversification plans. Although the development financial institutions are giving term loans to corporates, but the need of the hour is that the development financial institutions should divert their term loans to infrastructure sectors for their long-term needs rather than giving the loan to Indian corporates for their own diversification and financing part. It is advisable on the part of Indian corporates to raise the funds of their own. Say for example, they can raise external commercial borrowings for the diversification. They can raise equity component through the capital market through an IPO, preferential allotment or an FPO if they are already listed for their diversification, and let the funds flow from the development financial institution to other important sources which are required by the Indian economy.